tonight we're going to talk about wills and wine, and a little disclosure. I mean, I think it's clear I'm not a tax preparer. That's why Randy's in the room, and I'm not an attorney. That's why Thomas and Kaylee and Caitlin are here. So we will field some questions toward the end. If you have some questions as I'm going through this, though, please interrupt. I'm totally good with that, and I'd rather ask it or answer it when you think of it. So please interrupt. And please, get up and get more food and wine. Casual affair tonight. We do, as I said, have a lot to go over. We're going to talk about what is the term estate planning, the difference between a registration and assets and investments. And the reason this is in here is because it's pretty key to the documents you have and how assets pass. So this is a key piece I want you to understand. And then the difference, the classic question of what's the difference between a will and a trust, distribution scenarios we're going to go through along with estate tax, actual taxation in Oregon and Washington. We're going to talk a little bit about charitable giving and then still have some time. So what is the thing that people think of when you say estate planning? Okay, you can. Julie,
I can't answer.
Julie can't answer. Someone else. What's the first thing you think of when you think of estate planning?
A lot of work.
Somebody died.
Someone died and a lot of work. That's exactly 100,000 grand is we're going to start off. It has a process of arranging your assets, will receive your assets when you die. That's like what people think of, and so they really don't want to address it. But estate planning is so much more. That term really encompasses a lot of different things. So that's what I want you to think about. Yes, it is passing your assets when you die, but it's a lot more. It is thinking about federal and state estate taxes, understanding what those are. It's figuring out health and financial affairs while you're living, dealing with that if you're not able to. Account for separate property and inheritance. So whether those are second marriages, stepchildren, inheritance, keeping those separate assets. There's a lot of planning that can go into that. Protect assets from spend down or to provide for care. You may have family members or children that you don't think will deal with money well, or they may have special needs and you want to protect their benefits. There's planning that needs to be done for that. And then care for minor children and those with special needs, and then your charitable goals. So there's a lot that goes into the concept and the term estate planning. So what happens if there's no estate plan? If you don't do anything?
Die intestate.
So the term is intestate, you are correct. And so what happens if you die intestate? That is the correct term. What happens? It goes into probate. The state decides what's going to happen with your assets. Sometimes this is a nice motivating factor to know that if you do nothing, the state is going to decide for you. First, by intestate laws, if you I can't forget, you got to be rewarded for that one, because you even know. Right, and by default, your spouse or a state registered domestic partner will receive your assets first. If you don't have that, then your children, if no children, then living parents, and so on. So it kind of goes through lineage for default. And sometimes this is motivation enough for people to say, I don't want that to happen. Or I don't want it to happen where they're just going to get everything. And so just know that if you do nothing, this is the default. So I said estate planning encompasses a lot. It can encompass all of these things. This is 201, so we're going to cover this. This is the goal for tonight. We're going to talk about wills and trusts, and we're going to talk about beneficiary designations and registrations and how those three work together and separate. And we're going to talk briefly about probate, and we're going to talk about power of attorney and advanced healthcare directives. The reason these three things work together is because how your assets pass is dependent upon how your assets are titled. And that's why we're going to talk about registration of your accounts, because that dictates how your assets are going to pass. These three things work together. If you have a will, and we're going to go into more detail, then you'll go through probate. And while you're living, there's a power of attorney, typically for your financial, and there's an advanced healthcare directive or a power of attorney for your healthcare. And those are ancillary or addition to some of these other documents. But just understanding there's these different components, and some of them you might have literally all of these potentially. It depends if you've gotten everything coordinated, because you could potentially have all of this happen. Not ideal. And that's what we're going to try and avoid, is that your assets pass as you wish and you don't have something in every category.
I have a question.
Yes.
If your power of attorney includes a healthcare director, separate.
Thomas, I would say sometimes it's in the same document. Oh, repeat the question. If your power of attorney covers both financial and health, should they be in separate documents?
So it depends if you want to be the same person. Like we normally draft like your healthcare direct or your healthcare power of attorney and financial power of attorney in separate documents, because a lot of times people may want to trust a different person with the finances than with the healthcare. But you start. So it's the same person, you could put it together in one document, but just as like our standard practice is we keep them as separate ones. That way, if you're updating one, it's easier to make that change. And also, then we don't have to have all the banking provisions going to your doctors. We don't have to have all the medical provisions going to your bankers.
Oh, that brings up another question. May I ask?
Yeah, I just want to make sure, let me answer for those online. I don't know if you can figure out if they can hear or not what Thomas said is.
I haven't heard otherwise.
Okay. Thomas, I think you're speaking close enough to the microphone.
Oh, okay, right there. That's the microphone right there.
Oh.
Yeah, but just be sure to repeat the question. Yeah. Second question.
So whereas doctors will abide by the power of attorney, it's my understanding that banks.
Depends. I'll say here's our practical experience. The question was for a power of attorney that doctors will follow or abide by a power of attorney, but banks may not. My experience is, yes, it depends. What is usually more the case than they won't abide by it is if it's very old, they want verification that it's still current. That's what we run into more often than not. Thomas?
I was like, we're lucky in Washington State that there was an update to our power of attorney law a few years ago, so that if a bank or other third party is not honoring a financial power of attorney and you've given them an affidavit that says it's current and it's valid, and they don't accept that, and then you have to hire an attorney who has to go and argue with them and take them to court, they're responsible for your attorney fees. I haven't had to do that, but I've got a colleague that had to do it. He went to court to have to do that. The judge encouraged that his legal fees were much higher than they were, because he wanted to make sure that the banks weren't giving people a hard time. So they've got that kind of extra mechanism there that the bank's going to be on the hook if you have to do the extra work.
I really do also encourage people to update their power of attorney, not frequently, but if your power of attorney is older, say, I could even say 5+ years, There's also things that have changed that you might want to include, like a power of attorney will address digital assets now, and an older power of attorney might not. So there's also reason other than it being more accepted if it's current. There might be some other reasons, even if the person is the same person you want to appoint, other reasons to consider updating it. So, okay, good questions.
I would just like to say, I think it's really important to appoint somebody else as a backup power.
So the statement was to appoint someone else as a backup power of attorney. So typically in a power of attorney document, it does say this is the first person. And if they can't, then we do encourage a second or third person to be listed, because it's possible their situation has changed and they're not able to, they don't want to, you know, there's reasons. So I agree. We encourage definitely more than one person to be listed. Yes.
Is it preferable to have somebody other than a family member?
So the question is it preferable to have someone other than a family member? And honestly, it really depends on the family and the dynamics and the person. There are plenty of people we have family be that. The reasons, I mean, there's multiple reasons you wouldn't. Part of it is you just don't want that burden on a family. They're quite capable. They're someone you trust, but you don't want the burden because it is a responsibility. Maybe they're not local. And so you want to appoint a professional person to do it, or someone who's local that you would trust. You might also do it because, or not have them because you don't want, similar to not the burden, but you don't want the dynamic of siblings, you know, like, well, why did they get it kind of thing. So there's multiple reasons you wouldn't have family. Aside from you don't trust them, or they're not good with money, or that's not their wheelhouse. Like there's other reasons you would consider, but it's not a right or wrong. It really is your, I hate that's my classic answer, but it so depends on that kind of personal relationship. Okay, we're gonna get into the difference between registration of accounts and then what assets and investments you have. So a registration is how an asset is held. You could have, these are just some examples, but it covers a lot of different things. So an individual registration means your name is the only name on that account. It's your individual, one person's name. There is a designation, we'll go into this in more detail, with a TOD or transfer on death. It's still an individual account. You're the only one who has authority over that asset, but with the TOD registration, it automatically is a beneficiary. Joint tenants, you would see a lot of the JTWROS, joint tenants with right of survivor. So if you have two people on the account and it's joint tenants with right of survivor, if one of those, either of those people pass away, whoever survives becomes 100% beneficiary of that account automatically. So when you see that JTWROS, you see that a lot, that's what that means. It's joint tenant, both own it, with right of survivorship. Tenants in common, you don't see as much, but the reason you might do a tenants in common is maybe two siblings inherit something, or you buy something with a non-spouse kind of friend kind of thing. A tenants in common means that you own it together, but I own my 50% and you own your 50%. So unlike joint tenants where if I die, you get 100%. With tenants in common, one person owns their 50%, the other person owns their 50%. So if this person dies, their 50% goes according to their estate planning. This other beneficiary, this other tenant does not inherit that 50% necessarily. So your tenants in common, not immediate right of survivor. And then you get into IRAs, Roth, 401k, simples. All of the retirement accounts are registrations. The reason this is important, I'm going to hammer on this a little bit. The reason all of this is important is each of these, if I look at a statement on an account, I can tell you what the rules are of that account. I can tell you who can act on it. I can tell you if it is taxable. I can tell you if there's a beneficiary. I can tell you if you have to take distributions from it. These registrations dictate how the account passes from an estate planning standpoint. It dictates who has control and authority. It dictates how distributions can and have to be made, what the taxes are. So this registration is rather important. And so when you're thinking about how does my estate planning come together, you really have to look at how your assets are titled. And this, so the other piece of this is people say, I have a checking account. I'm like, that's great. Is your checking account in your name? Is it with your spouse? Is it with one of your children? What if you have multiple children, but you have one person on your checking account, as an example? That tells me if, again, let's say it's a joint tenant, you have one of your kids on your checking account, that child is the one who's going to inherit that account if you were to pass away, and that dictates it. So you can have these assets in any of these registrations. It's not the asset that dictates what happens. It's the registration. You can have a house, whether it's your home or a rental property, in any of these. I didn't add trust to this. Trust is a registration type. I love that out. So you can have a house that's just in your name. You can have a joint registration of a house. You can have it tenants in common. You can have it in a trust. The asset is whatever the asset is, but you can own it in a number of different registrations. Does that make sense? It's super important that you divide those two concepts, and you also look at the registration, not the asset, for figuring out what's going to happen to it. Okay. So now we're going to get a little bit into those different registrations, how they would pass. I'm going to go through it kind of once again with some examples. So if you die and you have an asset that's only in your individual name, there's nothing about that registration that tells you what to do with it. And so it would pass by your will. So if you die in your checking account and your house is in your individual name, someone will look to your will to say what happened with that. If you have an individual account that has the TOD, which is transfer on death, typically banks will use what's called a POD, or payable on death. It's the same thing, but a TOD and POD are interchangeable. Banks tend to use POD. Investment accounts tend to use TOD. And again, the TOD is still your individual name while you're living. You have complete control over it. But if you were to die, it designates who that asset goes to. Joint tenants, I think we covered. Again, if you have the two, one person passes, it becomes 100% of the survivor. Tenants in common, you have two owners, but you each own your 50%. So if this person passes away, and again, even in a tenants in common, I say per will or trust language, because your 50% might be owned in a trust. And so you would look to the trust to say what happens with my percentage of asset. And I say 50%, you could own 10 or 70.
That was gonna be my question.
Yes. Yeah. So tenants in common doesn't necessarily mean 50-50. You could have an agreement of something else, but it's going to pass per your will or trust language. And then in a trust, it's going to pass per the trust language. And then all your retirement accounts, with this caveat that you have actually designated a beneficiary. Because if there is no beneficiary, you just didn't do it. The person you designated died and you didn't do a contingent beneficiary, then it's going to go back to your will to figure out what has to happen. So just as important of keeping something like a power of attorney updated, reviewing your beneficiary designations is also super important. I'm sure Northwest Legacy Law, our attorneys here tonight, can tell you as many stories as we can around you. You have not only people who passed, and I'm not going to get into the layers of this, but you could have ex-spouses, you could have people who passed and it's done per stirpies, which means it goes to their kids and you're like, I don't want money going to my siblings' kids. But so the beneficiary designation, super important that you keep those reviewed and updated because all of those assets pass that way. Okay, so any questions at this point? Okay, we're going to get into an example. Let's pretend these, well, I'm going to ask first, what are these? At first. I heard a couple. I won't really too hard. Oh. Okay. Yeah, I think I heard one over here. Hear one over here? Oh, okay. You're right. These are assets. So let's say someone has checking and savings. What we're going to do is we're going to go through a scenario of an individual, someone with joint accounts and someone with trust accounts. And then we're going to use those kind of these assets in those three scenarios to say what would happen and kind of put this into play. So someone has a checking and savings account, a house, an after-tax investment account, meaning it's money that you have put in from savings. It's not a retirement account. So after-tax just means it's money that you saved, that you get the 1099 at the end of the year. Those are taxable investments. An IRA, a Roth, and some life insurance. So just a good smattering of different things. I've left off the other kind of ancillary pieces. Let's just focus on these types of assets. So for the registration, let's say this first scenario is an individual. And the individual has their own name on their checking and savings and their house is owned only by them. But let's say they opened the after-tax account and they thought at the time, I want that to go to a beneficiary, and they put a TOD. You know, we asked that maybe they were opening the account. We said, oh, you know, do you want to put a beneficiary on this? And they did. And then they also kept their beneficiary designations updated on their IRA, Roth, and life insurance. So what happens, these two pieces of the pie go by their will. All passed by the beneficiary designation. And this is why the registration is so important. We're going to get into kind of how that plays out with dollars. But one might think, I've done a will and I want X to happen. But if these aren't coordinated, those might be very different people that you've designated in your will. And so understanding how an asset is going to pass is the key to aligning your estate planning and your goals.
But maybe is that not the will? I mean, you know, if in my will I say that this IRA is going to go to, and it's in my will, that's not enough.
No, because it's super. Here's the key. A beneficiary designation supersedes everything. Your beneficiary designation. So let's say you have an IRA at Vanguard, Schwab, you have it, find out wherever, it doesn't really matter. You have any type of retirement account. That custodian is, when you submit a death certificate and say this person is passed, they're going to say, who's the beneficiary on the account? They aren't going to say, where's the will? Unless your beneficiary has died or you don't have one. then they'll say what happens.
So I want to throw out a caveat here. There's a Washington law that I don't think is very well known, and this is about something that's essentially called a super will. And this is something that you can put in your will that can actually supersede a beneficiary designation. And there are certain rules attached to it. It has to be done a specific way, and it would have to be brought to the financial institution's attention pretty quickly.
That is the key. So on a super rare occasion, from a practical standpoint, we do not encourage your beneficiaries of retirement accounts to be in a will. And there are reasons to do it. So never say never. It completely depends on the custodian. If you have a custodian where you've coordinated your will and it's controlling a retirement asset and the custodian says, don't care, that's the problem. So it can be done. Don't encourage it on most cases, but there are reasons always. But it really depends on the custodian.
Yeah. If you put a DOD or DOD on your checking or your savings in house,
Yes.
does that bypass the will?
Yes.
Is there
A reason not to do
that or not to do it?
We're gonna, when we talk about estate taxes, there is a reason to not have everything passed by beneficiary designation, and the biggest reason is having money to do those things depending on who gets the assets. And if your estate is taxable, and so you're over the estate limits, which we'll go over. If everything passes to a beneficiary, there's nothing left in the estate to pay the tax. So there's reasons, again, you would possibly not put everything with a beneficiary, but if you're under, it is, we're gonna go over this, like, let's say you don't have a house anymore, or you don't have a house, and your estate is under the estate limits, then everything can pass by beneficiary, and it's pretty straightforward. So the biggest reason, you might have others, the biggest reason is to pay estate tax and have money to settle things. It's the biggest reason. Okay, so individual, kind of the two separation of what's going to then pass by will or beneficiary designations. Let's say you now have your checking and savings and house as joint tenants. And in this scenario, let's pretend they're a spouse, that these two things are going to pass to the survivor. And so if these were joint tenants, it doesn't have to be spouse, any joint tenant registration, it's going to pass to the survivor. And now the survivor has all of these assets that they've inherited that have to be redone either now to their individual name, they have to put it in a trust, they have to put a beneficiary designation on it. So it passes to them. When this person dies, this first person dies, everything passes. No probate, like everything has a beneficiary designation in a sense. But now that surviving person needs to update everything so that it then passes to where they want. And similar to this, with a trust, it passes per the trust language. So you would look to the trust to say what happens to these assets. So let's pretend someone doesn't have a house. Same scenario, but the checking and savings of the individual account is registered with some type of beneficiary or registration that tells you what happens to the asset. Then that's going to pass either by the joint tenant or the TOD beneficiary, and all of those pass as the beneficiary designation. Kind of same thing. There's not a house to sell. There's just assets to pass. You're under the estate tax limit. This is pretty straightforward, and we do this a fair amount just to make it simple and pass, and it works well. I'm still going to say there are reasons to still have the trust or a will in place, even if you have this scenario, because believe me, I'm surprised how many times I'm like, oh, I found a stock certificate. I found a checking account. Like assets get forgotten. And so it's important still to have a will in place that will kind of catch things that maybe you didn't pay attention to. Okay, so we're going to talk about what is the difference between a will and trust. Any questions at this point?
Not a question, but just one thing I wanted to throw in, because we were talking about checking and savings accounts with sometimes you might put your kids on it or something like that. I just want to say one thing that I hear a lot from clients is that, hey, I have, my oldest kid joint owner on this account with me because I want to make sure they get help with things. And a lot of the time what they don't realize is the better way to do that is to make your kid authorized user of that account, authorized signer, if your intention is not for it to just go to them when they pass. And there's two reasons. One, if you're wanting that to be spread among other people, you're not getting that goal. And the other is because there's another owner on that account, you are now opening that account to more liability. If your child has a creditor, that is your child's account. And you may have meant that to be a convenience aspect, but legally, that child's creditor could come after your account. So I always tell people, what is your objective? Is it to go to them after you pass, or is it just to help you with your account? Yeah. So one thing to think about.
I completely agree. We do have that same conversation of it's convenient to think, oh, I'm just going to put someone on the account. I will say there are also some banks or credit unions that are easier to work with about having an authorized person versus making you put them as joint. So I guess that's the other thing is kind of know some of these things that are possible. And if you're getting pushback, like some of them too, really hard to get a checking in the name of a trust. Some of them, others, it's like not a big deal. So just knowing it can be done, then maybe you have to change your banking for some things to make it work. Instead of being forced to make someone joint on the account that you know that you don't have to do that. And I think in case those online didn't hear, I do want to make sure I repeat that if you put someone joint on your account, particularly a friend or a child, the creditor issue is real. If they're in a major accident, have some liability or bad credit themselves, they are an owner of that account with you. And so their creditors have every right to come tap into that asset of yours. Okay, exciting stuff, right? Yeah. Okay. A couple different ways to kind of describe the difference. So you hear about probate, and I'll give my opinion, and then you guys could chime in. So if you have assets like we talked about that are in your individual names and are going to have to go through the will, if it goes to the will, a will is a document that says, here's what I want to have happen with my assets. And it goes through the probate process, which is you go to the court and you say, this person has died. You get letters from the testamentary that says, this is the executor. They have the authority to now act on these accounts. That's what you would take to any of the asset holders, to transact on that asset. It is a public record. And that's probably one of the bigger sticking points for people. That's not always a bad thing because there's an accountability that goes with it. Whoever the executor is of will needs to say, here's the assets. There's accounting of that. They have to say to the court, here's all the expenses. I've paid for everything. Notice to creditors has happened. And now I'm going to distribute assets. So going through probate isn't a horrible thing. I think one of the things, there are some states where probate is super expensive. So everyone in California has a trust to avoid probate. Oregon and Washington, I don't know if it's changed dramatically, just knowing the clients who have gone through probate more recently. It's not a ridiculously expensive process here in Oregon and Washington as compared to some other states. So it's not the end of the world to go through probate. One of the big things though is it is more time consuming because you've got to go to the court, account for things, go through a process. So as far as efficiency, it might not be as efficient. Usually less expensive to establish a trust, just from a standpoint that you're not retitling assets and kind of going through that process. But the big thing too about a will is whatever you've said in your will, it's not valid until you actually die. So the will doesn't do anything until you have passed. We'll talk about this. You change it right up until the day you die, literally. And then assets are frozen upon your death. So if you have an individual account, if we get a phone call saying someone has passed away and the account's in their individual name, we're no longer allowed to transact on that account until we go through the process. So your assets are frozen. There's no one yet appointed, right, when you pass away to kind of transact on those assets. So that's another aspect of having a will. For a trust, you avoid the probate process because the registration, which is to have so-and-so is trustee of the so-and-so family trust. Again, it's a registration that is going to say how assets pass. So you don't have to go to probate. You don't have to go to the court and account because the trust and the language of the trust is a registration that's telling you how those assets are going to pass. So there's no probate, which means it's private. And so therefore can be faster to distribute assets because you can move ahead. When you've passed, let's say you have, I'm just going to keep it simple. You are an individual trustee of your own trust. You, as part of the document, appoint a successor trustee, someone who is going to act after you, either in incapacity or at death. So that person is already in place and notated in the document, usually at some point before you pass, but not always. That successor is already on the registration of the account and able to act. And so when you pass, yes, there's some logistics to it, but that they can sell homes, they can do things fairly quickly. It can be more expensive to establish a will. Again, the logistics of re-registering a house or other assets will require more attorney time and it can be a little bit more expensive. Not ridiculously so at all. Yeah, maybe a few thousand more. It's not that big of a deal. And it's also valid while you're living. It's a registration. So it's you as trustee of those assets that you have control over. It's a current registration. And it's there with the successor trustee, again, also in the document while you are in capacity or no longer interested in managing those assets that are in the will, sorry, the trust. And then the successor is also there after you've passed and the trust says what needs to happen with those assets. But all of that just can happen a little bit more seamlessly. And then assets are not frozen because the trust is existing. It's all in place and the language is there as to what happens and things can move forward. So what do these both do? A, you can name who assets pass to, who the beneficiaries are. That's the purpose of both of them, what you want to have happen. Revisions are allowed anytime. So just because you establish a trust or a will, change your mind if you want to. Life changes, people change, relationships change. Your asset, you might inherit new assets and have more money and think, oh, I want to benefit more people. I want money to go to charity. So you can change your documents at any time. The other thing is you can leave assets to minors and also provide for guardianship and kind of the rules around that. So and some people will ask, do I need a will? Probably the number one thing if someone isn't really having a lot in the way of assets to pass, if you have minor children, you need a will. Yes, Thomas, yes. Like, you still need a will because the will, most importantly, is dictating who's gonna be the guardian of your children. And there's guardianship of money, and then there's guardianship of finances. I'm sorry, their care. And those don't need to be the same person. You could have two different people be the guardian of finance and a separate one for their care. That's super important.
And I'm saying if they don't have a lot of money for naming the guardians, life insurance. We don't do life insurance. Talk to Heidi. Like, please get life insurance if you have a minor kid. Like, make there be a pot of money if you're not there to provide for them.
And it's pretty cheap when you're young and, you know, have young kids. Yes.
Is there a special tax treatment for trusts or how?
I'm glad you asked. I'm gonna answer that later. Might get a prize if you can answer.
I have one more thing to say about like the wills and trust. One thing that some people don't think about is if you have property in multiple states, you definitely want a trust, because otherwise that means not only are you in a probate, but you are in a probate in more than one state.
Yeah.
So you're doing that process multiple times.
So ancillary probate is when you own assets in more than one state. And so if you have a vacation home in another state, that's probably one of the biggest things. If you hold two homes, you know, one in Arizona or wherever, and one here, you want to have a trust so that you don't have what's called ancillary probate. And what Kaylee said, you're not filing in the state that the other home is and your home state. So that is a key reason for having OMB trust. Okay, I want to go through again just a different version, but say it a different way. So if you have a will or a trust or retirement accounts, while you're living, if you're an individual with and you're having a will, an income, you know, while you're living, you can do what you want. It's yours. You can spend it, sell it. You can do whatever you want with whatever the asset is. In capacity, you have to look to the power of attorney for that financial, and I added healthcare. I mean, mostly talking financial assets, but you have to have a power of attorney and healthcare directive for handling those two things at incapacity. The will hasn't come into play yet because you haven't died, because that death is when the will comes into play and your executor carries out through probate, is what we just talked about. If you have a trust while you're living, you are the trustee of your trust. At incapacity, the successor trustee is now taking over and handling those things. And also at death, the successor trustee is the one handling those assets. So this just kind of seamlessly passes at all stages with those assets versus at incapacity. The one thing I want to say though is your trust is only dictating those assets that are registered to the trust. So let's say so in capacity, let's say again, that was the checking account and the home, or maybe even an investment account. It's not the retirement account. It's not always, but could be life insurance. Only those assets that the trust owns does you as trustee currently or a successor have control over. So if it's a retirement account, those have to be registered in one person's individual name. There's no choice. There is no such thing as a joint IRA, which there could be because you have a lot of them. There's only an individual with a retirement account. So then you look to a power of attorney. So even if you have a trust, which might control a lot of your assets, it's not going to control all of your assets. You still would need a power of attorney to handle what happens with those other, like a beneficiary account or IRA account.
Okay, same thing with the healthcare POA.
Yeah.
That's what I was wondering why it wasn't on there. Those would be separate outside the trust assets.
Well, healthcare is going to really usually only address the healthcare. So it is, a separate document. Yes. That you would have, and I should have put that, yes.
Okay, yeah, I just wondered why I was missing on that. So,
yeah. And then retirement accounts, again, only your individual, while you're able to deal with it, you deal with it. But a power of attorney is what you would need in it. Again, if you have an older power of attorney, it might not have language that says, and you might not want this language, but a power of attorney can be very powerful if you want it to. You can allow people to change your beneficiaries, but you put restrictions in there as to, you know, what they can change. Or they can take only your required distribution. They can't take more, or they can do what they want. They can make your QCDs, your gifts to charity. You know, your power of attorney is what's going to dictate how someone can act on those retirement accounts. And then at death, the power of attorney that whoever was designated, they're no longer involved. Whoever the beneficiaries are, the ones that do the paperwork and claim their portion of the account. So what do we know? Classic Benjamin Franklin, nothing is certain except death and taxes. So going back to the earlier question, does having a trust instead of a will save taxes? No. All right, no. No. Now, here's what I would say. The act of having a will versus a trust does not save you on taxes. We're going to talk a little about what taxes there are, how you pay them, but the act of if you have a trust, that is not what saves you taxes over a will. It's the language within those documents that provide for assets to pass that might save you some taxes. But you can do that in a will or a trust. So having either of them over the other doesn't save taxes. Okay, so what are the taxes? In your packets are a couple handouts. One of them shows what the taxes are. And let's first talk about federal tax, federal state tax. So federal state tax, I put the 2023 number up here. If your estate is, this is per person, if your estate is under $12.92 million, you do not owe any federal state tax. If you live in Washington, this has been the same number since 2017, so there hasn't been an adjustment for inflation. If you have an estate under 2.193 million, you do not owe any Washington estate tax. So there are several states that don't have their own state estate tax, but Washington, Oregon both have one. So Washington is 2.193. And Oregon since 2001 has been $1 million. It has not increased since 2001. Pretty big difference between Oregon and Washington. And so it's kind of interesting. I would say we have a lot of Oregon clients and they don't tend to be motivated by this to Washington. But it's a pretty big deal when it comes to the estate planning. So it's something to plan for, particularly if your state in Oregon is over $1 million. The other thing I want to mention when it comes to taxes.
So you might want to also point out that $1 million is not the Oregon assets.
Oh yeah, it's all assets.
Entire estate.
Yeah. Yeah.
So having that $500,000 beach house in Oregon, you think they're safe? No.
So if you're a Washington resident and you have a $500,000 Oregon beach house, Oregon's going to still look at your entire estate.
Entire estate includes, say, both parents deceased. Both parents have a trust and both parents are deceased. So I understand that federal taxes, their combined assets on the trust will be combined. Is that the case for a Washington state tax?
Well, so I think what you're saying is your folks set up separate trusts.
Separate trusts.
Yeah.
But upon death of both of them, one of them's already passed, but upon death of both of them together, their combined assets included in the federal estate tax.
Likely not, because likely what happened is the first person who passed, their exemption was likely used at their passing. And so that is now under a separate EIN number.
If it's the same EIN number.
That would be their social, oh, they have both the same.
No, they have separate EIN numbers.
Yeah, so that tells me the one who passed used the exemption, and those assets now are over here. And whoever's surviving, their assets are under their social security number, and only those assets would get included. We do know. That.
Have to go back to the tax accountant.
This mom and dad, or is this them leaving trusts to
No,
you?
this is what it is.
Okay.
But yeah,
we can maybe take that offline for answering. So,
well, it is going to come.
So estate tax is one piece of taxes. And a lot of people ask about paying taxes. And what you just asked and said earlier, like what's included in an estate. It is all the assets that I had up there. It is checking, it's your house, it's your car, it's investment accounts, it's your IRA, it's life insurance, death benefit, it's anything that you had an interest in, whether you were an individual or joint, or have a retirement account, or you own the life insurance policy, whatever you own, that is considered your taxable estate, or not the gross estate, not taxable, gross estate. So there's a state tax, and then the other thing I kind of like to bring to people's awareness is many of you have saved for retirement. You have money in a 401k, an IRA, some type of retirement account, and you put in, maybe you have some in a Roth, that's fine, but a lot of you probably put money in deferred retirement accounts. And so when you take those distributions, those are taxable. Well, they're taxable to you, or they're taxable to your beneficiary. Someone's going to have to pay tax on that money. So that tax, that calculation is separate from the estate tax. So your IRAs are included in your gross estate. Separate from that calculation is your beneficiaries are going to inherit IRA money, and they now have to take that money out and pay tax. And so one thing I like to mention is retirement accounts, the rule changed in the second time flies, probably 3 or 4 years ago now. The rule, only 2, seriously? It's longer than that. All right, so a few years ago, the rule changed where if you are not a spouse, like so friends, sibling, well, there's rules, friends, children, if they are the beneficiaries of those accounts, they have to take the money out within 10 years. So if you have a $1 million account and one kid, and the kid gets $1 million account, they have 10 years to distribute that. And that $100,000 a year is taxable to them. So it's something to think about when you're thinking about, you know, who you leave assets to. And we're going to talk about charitable and some other things. There are also some caveats to that. If the beneficiary is less than 10 years younger than you, then they can take it out over life expectancy. And if there's special needs involved, they can take it out over life expectancy. So there's some caveats to it, but in a lot of instances, if it's not a spouse, and if you have those caveats, your beneficiaries have to pay tax.
Another good reason to make sure you're staying on top of your beneficiary designations is that if you didn't and it went to your estate, that number changes to 5 years. So if you're going down to your beneficiaries through a probate, you just cut that number in half to 5.
So for those online, if you did not keep your beneficiaries update on your retirement money and it ends up going through probate because there's no current beneficiaries, then that gets cut down to 5 years to distribute the money. And it goes through that list of spouse, children, siblings. It goes through that list, but they have 5 years. Didn't know that. Because we don't let people not update their beneficiary designations. Yes.
Sorry, just to clarify, so the non-spouse beneficiary designation, that is new in this last 2 years, that there's a 10-year limitation that years ago, non-spouse inherited tax deferred assets.
They got to take it over their life expectancy. Yeah, which so it's huge.
Yeah.
I mean, it's a big number where if you had a $1 million IRA and your kids inherited, well, now they maybe need to take out, let's just say $20,000 or $40,000 well, yeah, let's say $20,000, $25,000. Now they've got to take out over 100,000 and get that distributed within 10 years. So then there's a fair amount of planning on their end because you've added that taxable income to their income, whatever they have. Okay, so let's talk about, I'm going to pause just for a second before I get into the exciting calculation of taxes. Does anyone need to take a break? We need 5 minutes to stand up. No? Okay, yeah, keep going. Okay, so let's put some numbers to this. Gross estate, let's say these assets are in a trust, 100,000 in checking, 500 of a house. This person still has their TOD account. They have not put it in the trust. Okay, they have not coordinated things with their trust. And then there's IRA and life insurance. So there's a 2.1 million estate. And asset class like we've talked about. Let's say this person in their trust has spent 40% of these assets to person number 1, 40% to number 2, and 20% to charity. And then for the TOD account, maybe it was years after they'd already done the trust, and they're like, "Oh, I want to put this person on that account." But they've done their IRA and their life insurance some time ago, and they put 50% to person 1 and 2, and then for some reason they opened a Roth and decided to give it to someone else. So got people all over the place, but in their mind, they're thinking, I'm leaving 40% to number 1 and 40% to person number 2 and 20% of my estate to charity. And that's just not how it ends up flowing, going back to the registration dictate. So if you have, this is how things were to pass, person number 1 ends up with 35% of the estate. Person number 2, 35%. Person number 3, they get the $300,000 account, and person number 4 gets their $200,000 account, and charity ends up with 6%. Where maybe in your mind, because of the trust saying charity got 20%, you're thinking that's what they get. But because of how the title and registration dictates how assets pass, this is the actual percentage of how that would happen. So often what we're doing is a spreadsheet that says who are the beneficiaries, what are the assets, and you kind of put it in an Excel spreadsheet to show how assets would pass, so that because you would have beneficiary designations plus a trust or a will that would dictate. And so putting them on a spreadsheet is a good way to kind of say how much ultimate does everyone get. So if you were in the state of Washington in this scenario and you have a $2.1 million estate, it's not a taxable estate. So you don't have to worry about Washington estate tax. But let's pretend you're in Oregon and you have the 2.1 million estate. I have simplified this. You get to deduct other things, but for illustration purposes, I just simplified this. You get an Oregon estate exemption, so you get to the $1 million taken off. And the amount going to charity, because they got 20% of the trust assets. So the amount going to charity, I should have actually 120. So there's 980 that's still taxable. On the back of the sheet that has the federal and Washington and Oregon, on the back of that are the tax rates in all states. So you can see how much, you know, those numbers go up. So the first 500,000 is a 10% in Oregon. The next 480 would be a 10 and a quarter. And so you end up with 99,000 in taxes. But here's the thing. All of the assets, going back to this, the assets that are going to pay the tax are the assets in the trust. Because you can't go to the IRA beneficiary or the TOD beneficiary. The trust assets are the assets that are going to end up paying the trust. So that's why I have a deduction of that 99,000, 40, 40, and 20. So in this scenario, then these two first beneficiaries that were theoretically going to get 40, now they're at 33 instead of 35. The other two are going to get their full percentage, and then charity is going to still get 100,000. So again, understanding what registration dictates how an asset passes, but then also back to your question about what if everything passes by a beneficiary designation? I might be able to answer this. Let's pretend someone did that and they have a taxable estate. How does the state know to come back to them to try and collect?
So they may not. So this gets into one of those pieces where we have like this voluntary reporting of it. So it's like you have one, so if we had a client that was receiving one portion of it, but they didn't have control over the other assets, they might file an estate tax return to say to the Oregon Department of Revenue or Washington Department of Revenue or IRS, this person died, they had a taxable estate, we don't have control over these assets, and then letting the taxing authority know about that. And so, yeah, so there's state law that says about how you can go after people even if they receive something outside of it, if they get the transfer on death. So there's a legal mechanism to go after it, but in terms of practicality, that being a fun thing to go after, that's certainly not something that we would, I mean, you're going to spend a lot of money to go after that person. The problem is, if they got the money, they probably already bought a new truck or spent it remodeling their kitchen or doing something. So it can be done.
Good help. And I've not run into that before.
We haven't either. Thankfully, we haven't had to go chase this.
So this is where, you know, if the other thing that's important to know, the things that come off your total estate are the exemption in either state. And then the amount that goes to charity also comes off of your taxable estate. And then final expenses also come off. So any attorney fees, you know, funeral expenses, final expenses to sell something, or any expenses kind of to manage and pay for the estate come off as well. Okay. In this presentation, because I'm going to talk about charitable giving a little bit next, I want to leave plenty of room for Q&A. What I've not gotten into is the process in your will or trust of if you have, let's say, a $4 million estate. In your will or trust is creating the language if you have a couple where upon the first death, like what you were talking about, upon the first death, making sure the first person who dies using their exemption. Because going back to this scenario is if you have a couple and everything is left to the survivor, but let's pretend this is a $4 million estate and you just flat out leave everything to the survivor of the couple. Now the survivor has a $4 million estate. So the process of a will or a trust is upon the first death, if you have a taxable estate and there's enough of the assets, is you say, upon the first death, I want to use the exemption of that person. and you put assets in savings trust, it's called a number of things, but you use that person's exemption, and then that trust is used that, and what's remaining, whoever's surviving can still use those assets and have control over it. But what's remaining then is in the survivor's estate, and you hopefully have reduced that to a point that they're going to avoid ultimate estate tax. So that's how the planning is done, which I'm not getting super into.
I was gonna say, one way I like to really simplify that concept is, you know, when we talked about federally, that really big number, we have this concept called portability. If you didn't use the whole number, you can give it to your surviving spouse. On the state level, you can't do that. If you don't use your exemption, you lose it. So the things that Heidi's talking about right now is how you use that exemption. You don't get to pass it over.
Yeah, so the portability on the federal level is a really nice feature so that you don't have to do that side of it, but it doesn't exist, as Kaylee said, on the state level. You have to do that planning to use that exemption of the first person. Okay. Giving is not just about making a donation, it's about making a difference. We have a lot of clients who are charitably inclined, and I would say that saving taxes is not the motivation, that people have still given consistently, whether they're saving taxes. When the rules changed and the standard deduction happened, and some people take the standard deduction, and so their charitable doesn't count as much. It hasn't slowed down giving. There are a number of ways that you can give efficiently. This is about estate planning, so I talk about this a little bit, but I'm going to cover this first. I'm going to get off track. I think this is just interesting, and individual philanthropy is 67% of our giving in this country, and corporate philanthropy is a fraction of that, and charitable organizations is an even yet smaller fraction. Individual giving is what is a lot of our charitable giving, and it's supporting our nonprofits, not only in this community, but nationwide. So if you are charitably inclined, there are a lot of things that you can do to help not only save on taxes, but on your estate tax if you have a taxable estate or not. I mean, we were talking that the last time, there's plenty of people who say, my kids have enough. They don't need my money. I would rather it go to charities that we support, or they don't need all of my money. I want it to go to charity. So it's not necessarily even about saving taxes. It's more about where do you want your money to go. So from a giving standpoint, during your lifetime, many people give in writing the check or auto pay on your credit card, and that's great. Again, we do a lot of this, but a donor advised fund is a way for you to give appreciated assets into a investment account. And the donor advised fund, we use Charles Schwab, but Fidelity has it, Vanguard has it. You transfer your appreciated mutual fund, stock, whatever it is, into this account, and that counts as a charitable contribution for tax purposes. What is nice about that, and many reasons that we use the donor advised fund, is people are sometimes interested in giving, but they don't exactly know what they want to give to at the moment. And so the nice thing about doing this, not only can you do it and do some tax planning, like lump some contributions together, but you get the tax deduction in the year that that contribution was made, but you're not required to give that money away right away. I will say from a nonprofit standpoint, a lot of people have given money to donor advised funds, but then not given the money away. So it's not actually going to charity, which is the downside of a donor advised fund. But they are a great planning tool. And so it's something, if we haven't already talked with you about that, to consider. And then you can gift appreciated stock or assets directly to a charity. In that instance, though, you need to know that that's an organization that you want to give to. But, and the organization also has to be large enough to be able to accept that. A lot of the smaller ones aren't really designed to accept stock. They don't have a brokerage account set up. So there's ways to facilitate that. Again, going back to your donor advised fund, if you have appreciated assets, if you have a charity that you want to support, but they're not set up, do it into a donor advised fund and then turn around and grant from your donor advised fund to that smaller charity. It's a great way to not have them go through the hoops if they really aren't set up for that and not maybe sophisticated enough for you to still benefit and receive the donation. And then a qualified charitable distribution is QCD is if you are 70 and a half or older, you can use your IRA funds to give directly to charity. And the rule just says you do have to be 70 and a half. So whatever that calculation is for you, not start doing it for your 70 and 6 months that date, because then it does not count as a QCD. So some IRAs are set up where they issue you a checkbook, which is super convenient because you can just write your check like a normal check and send it off and it clears on the cash in your IRA. Other IRA custodians are not set up for that. You have to send in a distribution. So one of the things about QCDs, it used to be you had to take an IRA distribution at 70 and a half, and that's why at 70 and a half, you can do the charitable distribution and have that count as a charitable contribution. Required minimum distributions or RMDs, that age moved to 72, and I hear there is talk of moving it again. It hasn't happened yet, but at 72, you have to take money out of your IRA. When you're 70 and a half, you can start using it for charity. At 72, when you have to start taking an RMD, let's pretend your RMD is 20,000. If you decide to give 5,000 to charity, you will still get a 1099 at the end of the year saying you took 20,000 out of your IRA. It is up to you to report it correctly on your taxes. And what would happen is it would show you took 20,000 out of your IRA and it would say QCD on your tax return, and only 15,000 would show as taxable because you would show you gave 5,000 directly to charity. So it's a great planning tool. If you are charitably inclined with your estate and you have RMDs to take, you know, it's a nice way to give to charity now if that works with your cash flow and taxes for you to see the benefit of giving the money. I had another thought. Oh, QCDs you can use to offset your taxable required minimum distribution. But so let's say your RMD is 20,000. You're allowed every year to use up to 100,000 of your IRA to give to charity. So even if your RMD is only 20, you can give up to 100,000 out of your IRA in any given year and have it count. And then at bequest at death, again, within your will or your trust language, you may leave a percentage of your estate to charity. And then the other thing that we highly encourage is if you're going to leave a portion of your estate to charity, do it with your IRA beneficiary designation, because that is one sweet thing is the IRA is the charity receives the IRA money tax free. So when we were talking before about whoever you leave as a person as an IRA beneficiary, if they're required to take that money out over 10 years, it could be a tax hit to them. If you've put an IRA charity in your will and trust, now you've taken assets that your beneficiaries may have received tax-free and given some of it to charity, where the IRA, the charity is able to receive tax-free and more of the taxable asset can go to charity and less to people, and more of the house and checking money can go to people. So again, it's a coordination thing, but understanding that a charity can be the beneficiary of one of your technically life insurance, but IRAs are the best because they receive it without the tax. Okay. Covered a lot. All right. We had some questions when people registered that I want to make sure that we address, and then we'll open up for Q&A. Can or does a will address our digital information? Thomas? Haley?
Sure, I'll take it. So yes, it can. There are rules and laws that about, you know, giving people access to them. Although I would say, practically speaking, the much easier way to do that is I personally have not had to go through all the channels of, you know, getting somebody access through these laws. But from people who have had to, I've heard that it's a very cumbersome process. And one of the ways that we suggest to make it a little easier for people is have a safe place where you've written down your passwords. And, you know, when you're keeping, when you have, you know, something like your estate planning documents and something that you're planning on handing over to somebody that you're going to trust to do things for you, if you give that to them and they can manage things for you, access things, delete things as needed, that's really practically a much easier way to do it.
I had a client yesterday telling me that they had a person in a different state, but it took them 11 months to get access to the digital assets there. And it's a tough thing. But knowing like if you, like there's some accounts like on your Facebook, you can specify who the successor person is or safe person. So depending on the digital asset there, but digital assets are a tougher one that I don't feel like we've fully caught up in how we play them.
They're going to become more and more of an asset though. Take the time. So another question is it best to specify amounts or percentages for bequests? I'm a fan of percentages because things change. The one thing that we often see is if it's like I want just 5,000, 10,000, like let's say you have a larger amount, you know, is it going to get depleted? You want some smaller bequests to go to specific people. And then with the remaining, whatever, let's say you have, you know, $1 million and 5 and 10 and dollars goes to these people, then do percentages for the balance because that will change. You probably don't do any specific numbers.
We'll do either one for a client. Sometimes we will do, it's a certain dollar amount, but it's to be no more than a certain percentage. So sometimes we'll have a client says, well, I want to leave $50,000 to each grandkid, but they don't want them to be more than 10% of their total estate. So we can incorporate both numbers there to make sure we don't accidentally leave all the money to the grandkids and nothing to their kids.
That's a great way to do it. Yes.
Question.
Yes.
So in the case of someone writing down a number and, you know, once they pass, they don't have liquid assets for that number. What are the dangers of, I guess, would the estate have to then sell another non-liquid asset like a house to ensure that they come up with that number?
Yeah, and that's actually an issue with paying estate tax too. Like if you have assets, let's say in a trust that are 3 homes, but you only have $100,000 in assets, it is possible you'd have to sell a home to pay the tax.
What about foreign assets?
Oh.
What about them?
It's with assets in several countries, and every country is different. They're different in whether it's taxed in that country. It's different in whether it's taxed when it comes back here. It's taxed. It's different if it's taxed to the beneficiaries, if they're not direct relatives, like if you're not a spouse or children, and anything else is heavily taxed. Like I can think of 3 ones recently. I mean, it's just so different that every country you have to kind of research and understand.
But I would say at a basic level, like within the US, the United States is going to tax on your worldwide assets. So if you had, you know, $1 million bank account in Canada and a $10 million bank account in England, you're gonna have to pull all those in for your US estate tax in Washington. It's
Just like you have to report on the income taxes.
Okay. Someone asked about capital gain on the sale of a personal residence. So I'll just answer this. It's not necessarily estate planning. So the rule changed a while ago where some people think you have to sell, you get a lifetime kind of exclusion. And so the rule works like this. If you have a personal home, if you're an individual, you can exclude up to $250,000 of gain on selling your home. And if you're married, it's $500,000 of gain from, your whatever your cost basis is. You get to use that exclusion every 2 years on your personal residence. So, if you sell your home and made a lot of money on it, but it's less than 250 or 500, depending on your tax filing status, you get to exclude that gain. If you go buy a fixer upper and it's where you're living, it's your home, you make that gain again, you can do it 2 years later. Just make sure it's literally more than 2 years, because it is from date of sale and closing to date of sale and closing. So it needs to be 2 years. And so you can do that as many times as you want every 2 years.
What if someone died before the 2 years? They still get that gain.
It doesn't matter because there's likely a step up in basis at that point. So it probably doesn't matter. I didn't even go into that whole side of step up in cost basis. That's a whole nother topic.
People realize she's talking about home sell, doesn't work with prior homes. Can't move into a rental in there 2 years. It just doesn't work.
It doesn't work. It is proportionate though, isn't it?
It is proportionate. So that portion will never be excluded.
Right. So it's there, and we've run that scenario a few times where like if I'm not saying that it will run this way every time, but there's kind of a sweet spot when we run the numbers that you stayed in it that you'll exclude as much as you're probably going to exclude. So if you owned it for 15 years and you move into it and live there for 5, you're going to be able to exclude some of that depreciation and rental side of it, but not all of it like you used to. So how can we protect inheritance from our child if one parent dies and the other remarries? This really comes into planning by trust language, where you can really restrict assets on that first death to make sure those assets pass and have restrictions on how they can be used. So survivor can still use them, but ultimately those assets still go to the kids of the first marriage. So it's usually trusts that are restricting that and having the language. Harder to do if most of the assets are retirement though. Still do it with trust, but
yeah, you can still do it with a special type of trust for retirement accounts, but having a trust be a beneficiary of a retirement account is
not ideal.
Yeah, like most of the time, if we're trying to restrict that, we'll do it with different assets to make it work. Otherwise, it makes, when you're doing your taxes, it makes it more complicated distribution pools.
Discuss pros and cons of a transfer on death at TOD deed for real estate. I haven't seen too many people do TOD on real estate.
I think you run into like 2 issues with doing the transfer on death for real estate. Like, it's not our recommendation to clients, so we haven't seen a lot of people do it. The main thing that I hear from title insurance companies and other attorneys, and really to be title insurance companies, they're the ones that are the de facto ones that decide the rules, because when you want to go to sell the property, if the title company will let you do it, you're golden. The title company says no, doesn't matter if I say yes, if they won't do title insurance, you're in trouble. A lot of time, what I've heard from title insurance companies is they're worried about there being creditors. And so if you're trying to sell the property within 2 years of a person's death, you may run into some issues on the transfer on death deed with that. So if you're having it just stay within the family, like if it was a family cabin and it just went to your kids with a transfer on death deed and you weren't intending to sell it, may not be as much of an issue. Then the other issue that I worry about with the transfer on death deed is house is in my name, it's transfer on death to someone else. Well, then when it transfers to them, they may not have it insured after my death. We might have some gap in insurance, and it always feels like house fires seem to happen in the time we don't have insurance, even though you own the house for 30 years with no problem.
Yeah, I would suggest those things are more in trust for passing than the TOD. I would say I can't think of having seen that. But that raises another question that's super important. If you do put your house in a trust, it is super important that your insurance, your homeowner's insurance, adds the trust as an additional insured. Because if your trust is the owner of the property, but your insurance is you only individually, the trust is the owner. They're the one who owns the house. So if your insurance is only in your individual name, not as the trust as an additional insured, the trust doesn't have insurance. So you need to make sure you add the trust as an additional insured if your house is in the trust. Okay, trusts and trustees for children. I could go on and on about that. We're getting close to 7. I will wrap up on time and leave some time for Q&A. So we'll have to choose that for another day. Oh, I am going to answer this one. Does a will need to be notarized? So technically your will is not notarized. There is what's called an attestation page where your 2 witnesses are also signing an attestation page, and it is their witness signatures that are notarized on that. It's not your will. So that is like, you don't get your will notarized. It's the signatures of your 2 witnesses on an attestation page. And if you don't do that, and you go to court, am I correct on this? The court needs to know that those 2 people are valid. So you kind of need that attestation page to go with the will.
The attestation makes it so those 2 people don't have to come and give life testimony. So that's why, like in our office, Kaylee and I witness a will. We sign that attestation page so that 10, 20, 30 years down the line, someone's not trying to come and find Thomas and Kaylee to go into court to say, yes, that person signed that will.
And what if someone doesn't have that, didn't do that, and those people aren't around anymore?
Then it gets complicated. I mean,
okay, so get the attestation page signed. Leave it at that.
If we can find one of those people, we're normally good. Okay. If we can't find one of them, well, we're crossing our fingers.
Okay, what questions? I want to make sure we answer a few questions.
One from one of ours.
Yes, online.
Can you verify? She says it doesn't sound smart to keep your house for decades if there's only a $250,000 exclusion because it's increased in value after so many years.
Not necessarily. I mean, paying taxes, it's just part of it because there's a number of reasons that you might still keep a home. A, it's the most cost-effective place for you to be. You don't want to move. If let's say you had a $600,000 home that you bought way back in the day for $200,000, and so you have $400,000 a gain. And let's say you're an individual, so you can only exclude 250, and so you have 150 that's going to be taxable. The other expenses that come off of that are the selling costs, which are not inexpensive with realtor and excise in Washington. Have those expenses come off. So let's just say you still have 100,000 that's taxable. It's capital gain tax, which is probably going to be 20%. So it's $20,000. I mean, if you kind of look at it in that scope of things, you're still selling it for $600 and maybe paying $20,000 in taxes. And that's probably better than potentially moving if you don't really need or want to.
Can you deduct though any improvements that you put in the house?
Yes. So let's say you did buy it for 200, and improvements though are not replacing the roof. Improvements are remodeling the kitchen, adding a bathroom. Like they got to be major improvements. So it's not replacing carpet. It's not replacing a roof in a sense. And yes, Brandy says yes, putting in a fence.
A new fence, not replacing a fence.
Oh,
Repairs or not?
yeah.
Repair repairs.
Yeah. Okay, what other questions? Yes.
So buying a second home in Oregon exposes an entire state.
Yes.
Oregon's state tax.
Yes.
But if you own that Oregon second home in an LLC,
Right. Separate entity.
if what you put in an LLC, all of a sudden it's then not, it becomes intangible personal property. And if you're a Washington resident, it's then not subject to Oregon state tax. So there's a seemingly strange rule that when we go back to like the things that Heidi was saying way back earlier about the difference between registration and the investment, if you have that registered in the LLC, you get it out of the order.
And now you have an extra tax return.
If it's an Oregon LLC, husband and wife, it's not disregarded entity, it's a partnership. Yeah, that's true. Put your kids on it.
Yeah, that makes it more complicated. That makes it worse. Okay, we will be here for questions. I do want to say thank you to Thomas and Kaylee for chiming in and helping, and also to Randy. We will be here for a little longer if you want to ask questions. Oh, I'm so sorry, because the other thing I wanted to mention, so we have a lot of clients who are interested in charitable giving, and Ripple Impact Northwest, Jeannie Coaches is here in the back, and we have a table out there. Ripple Impact Northwest was founded as a way for clients to get more information about how to give and potentially who to give to, and kind of explore what's important to them. There are 3 programs. One is a discovery workshop, one is some different giving circles, and then there's individual consulting available. But recognizing that a lot of people have charitable intent, but they're not sure how to go about it, this is a great resource for you. So please chat with Jeannie on your way out and grab one of the brochures and look for upcoming giving circles in 2023.